President Donald Trump announcing just moments ago that the United States and the European Union reached a framework for a trade deal after his talks with European Commission President Ursula von der Leyen at his Turnberry Golf Club in Scotland.
Donald Trump has signed a new trade deal with the European Union, targeting sectors like cars, luxury goods, pharma, and machinery. While it's presented as a win for America, the hidden impact could be serious. German automakers like BMW and Mercedes now face higher U.S. tariffs, threatening their sales. French and Italian brands like LVMH and Barilla may lose buyers as their products become more expensive. Pharma companies like Sanofi and Bayer are entering uncertain territory, and industrial giants like Siemens could face rising export costs. Even Airbus may lose out as the U.S. leans toward Boeing. In this video, we'll break down who's really losing in this deal and what it means for the global economy. Don't forget to subscribe and hit the bell because this story goes deeper than it seems. Trump's new trade deal with the European Union, the economic impact is beginning to show, especially across key European industries. German automakers like BMW, Mercedes-Benz, and Volkswagen are directly in the crossfire with U.S. tariffs on European cars jumping from 2.5% to as high as 15%. These companies are now facing the hard choice of either raising prices in the American market or absorbing the loss themselves. Either option cuts deep into profits. And with American buyers already looking at cheaper alternatives, especially from Asian automakers, Europe's grip on the U.S. car market could begin to slip. Luxury food and beverage exporters from France and Italy are also taking a hit. Brands like LVMH, Campari, and Barilla rely heavily on the U.S. for premium sales of wine, cheese, pasta, and olive oil. Now, due to increased tariffs, these goods are becoming significantly more expensive for American consumers. That means falling demand, shrinking shelf space in U.S. stores, and in some cases, paused expansion plans. Smaller artisanal brands that were growing in the U.S. are especially vulnerable. Pharmaceutical giants like Sanofi and Bayer are dealing with regulatory pressure as Trump's administration has begun targeting European drug companies with scrutiny over pricing and production standards. The fear of added tariffs or import restrictions is already spooking investors. Stocks are becoming volatile, and confidence in long-term operations within the U.S. is shaky. These companies may now have to rework their distribution models, invest more in local U.S. production, or face market loss to American drug firms. Industrial powerhouses like Siemens and ABB, who manufacture heavy machinery and automation equipment, are facing new export barriers. The U.S. was a critical destination for their advanced engineering products. Now, with increased tariffs and trade restrictions, these firms are likely to see project delays, lost bids, and client hesitation. American buyers may shift toward domestic manufacturers or cheaper Asian suppliers, cutting into Europe's industrial competitiveness. Airbus, the European aerospace leader, is also positioned for a tough stretch. Although aircraft tariffs were not formally increased in this round, the U.S. government continues to favor Boeing in both defense and commercial contracts. Trump's Buy American stance has translated into clear political support for Boeing over Airbus. The damage here is more strategic, fewer contracts, longer negotiation cycles, and growing distrust in U.S.-EU aerospace collaboration. Steel and aluminum producers such as ArcelorMittal and ThyssenKrupp remain bound by pre-existing quotas that Trump chose not to revise. These companies hoped the new agreement might loosen export restrictions, but that didn't happen. Instead, they are stuck with production surpluses they can't ship, facing lower global prices and tighter margins. It's a silent but significant hit. Shipping and logistics companies like Maersk and DHL Europe are feeling secondary effects. As trade volumes fall due to these new barriers, shipping demand drops, freight prices stagnate, and operational costs per shipment increase. For firms that depend on steady, high-volume U.S. exports, this is an early warning of long-term strain. Altogether, this trade deal, rather than opening doors, has quietly reinforced barriers. Europe's largest companies across multiple sectors are now facing a perfect storm of reduced access, regulatory risk, and pricing disadvantages in one of the world's biggest consumer markets. The long-term consequence may be not just economic loss, but a reshaping of global trade patterns, one where Europe finds itself increasingly sidelined. In the end, what might seem like just another headline or policy shift is actually the start of something much bigger. Trump's trade deal with the European Union isn't just about taxes or tariffs, it's about a dramatic shift in how global business is done. For decades, European companies like BMW, Sanofi, LVMH, and Airbus operated with a sense of stability in U.S. markets. But now, that foundation is starting to crack. These companies are being forced to rethink strategies, cut costs, and in some cases scale back their presence in America altogether. What we're witnessing isn't just economic pressure, it's a redrawing of the global trade map. Alliances are shifting, trust is fading, and the cost of doing business is getting heavier on both sides. This could lead to slower growth, job cuts, and rising prices for everyday consumers, not just in Europe, but around the world. As the dust settles, one thing is clear. This deal has created more questions than answers, and the real impact will only become visible in the months ahead. We'll be here to unpack every twist and turn as it happens. So if you want to stay ahead of the story, don't forget to subscribe and turn on the bell because this is far from over.